Welcome back to the Business Tech FinTech Conference for 2022. I hope you powered up your batteries, you're on full charge as we charge headlong into the next session with a man who is certainly charging into the asset management scene here in South Africa. He's got big plans, he's doing eye-catching deals, and dare I say, building the local vanguard. Tobie van Heerden, Chief Executive of 10X Investments. Tobie, always great to chat to you. Talk to me, what is the biggest talking point in the asset management industry in South Africa right now?
Hello, Michael. Good to be on your show again or on the conference. It's great to be here. Thanks for the invite. It's interesting. I think there's two big talking points at the moment in our industry. The one is this whole global allocation for asset managers. It's become quite a big number at 45% taking your money offshore. Clients, it's certainly specialist clients, like big institutions are asking the question in a sort of a global balanced fund environment. Can my South African manager do it? We've seen some certain in the market the last week, some very diverse views in terms of our capabilities in South Africa. So I think that's a big thing, because all of a sudden 55% domestic assets invested inside South African managers certainly got the skill set to do that. And so the big question mark is, can South African managers do the 45% component? It makes it very, very tricky. And certainly the biggest call for me is always how much offshore, how much onshore. That 45% switch, because the rand is such a volatile beast. Getting that call right is sometimes much more important than where you place the money offshore because of the rand volatility. And to do a sort of a strategic or a tactical allocation around how much you should put offshore is very difficult, especially if most of the liabilities of pensioners are actually in South Africa. So I think that's one big thing that's hitting the market at the moment. And the second, I suppose, is, and we'll talk a bit more about this, is this whole issue around fee pressure and costs and index investment or passive investments that's on the rise. And at our business is certainly, we think very well positioned to participate in that. But that's the next big thing in South Africa. And there's a lot of talk around allocation to index funds and getting costs down for the investors in the street without sacrificing the quality of your investment portfolio.
Well, to your earlier point, Warren Buffett, he's one of the most well-known investors of our generation, said he would rather trust his retirement funds in an S&P 500 index tracker than picking an asset manager who's going to try and pick winners. Now you're talking about going offshore, local managers trying to pick winners offshore. It just adds an extra layer of risk. So that seems to be playing into some of your big strengths at the moment in terms of what you're building over there, Tobie. But also what we have is this whole emergence of the era of big data. And we often talk about the fact that, God, we trust, everyone else bring data. It's like the big buzzword at the moment. But what data insights present the most compelling in terms of industry growth? And what role is the technology playing in the industry right now? Possibly an industry that hasn't always had tech, so to speak, as its core, as an enabler for change and growth.
You're very much right. In terms of the asset management industry, we've been very protected to a large extent from the sort of, let's call it the 20th century technology revolution or FinTech in that respect. And where we've seen technology being used in asset management has typically been on the investment side. So we've seen some clever guys dividing some clever models and spreadsheets and things in there, and that's sort of been used to use it as an advantage at some point to create alpha or excess return for investors. But as we see the rise of big data, we've seen a lot of those models being disintermediated, so that the efficacy of those models being reduced over time as data has risen. So typically we've seen it in the investment space for an asset manager. Where we're now increasingly seeing it is on how we engage with customers and how we take new investors on. So that KYC or the application process being much more smoother, much more easier for customers. And that's been at the back of what we've seen with digital banks. So digital banks have really taken the revolution there, and they've made it very easy for customers to open bank accounts and to trade on those bank accounts. And so asset managers jump quickly on that bandwagon to say, okay, let's make it easier for customers to invest. However, and this is where I think a big piece of work lies for us, is on the data side. We have not, as an industry, been able use data and put data at the center of our business. And that's what we're doing at 10x. We're putting data, and this is all sorts of data from the inside of the business, our own client, customer data, our investment data, all the data we have from the inside, plus our external repository of data, stuff like Bloomberg, Reuters, all of that data we can pull into a central repository. And then you build APIs either to your investment team, to your client-facing team, or to your clients in terms of your reporting, or to your administration team to make the journey much more efficient, to make your business much more efficient. And I think most of all is what we're trying to do here is make investments more accessible for the man in the street. Now, that means we have to tone down the level to which we articulate our investment proposition and how we get them through the door. And then once they're invested, how we continue to work with those investors. And that's where tech and data becomes super powerful, where you can actually understand your underlying customer, you understand their needs before they know their needs. So this is typical FinTech sort of speak, but that's exactly what we're trying to do and rebuilding in our business. So to help investors engage in their investment journey before they actually start that journey, but to push them over that brink to say, you know what, whether it's 500 Rand a month or 250 Rand a month you want to save, here's the journey that we think you could take here very well. And the flip side to that is obviously the advisors that we also support is how do we help and build tools for advisors to engage with their customers in a much more efficient way where they can fill their needs quite quickly. So it's those two tensions that we're working on very, very hard at the moment, but it's building that inside data capability, which is super, 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 super important, which we are doing.
I think it's a smart strategy because you can see in both of those pillars on the independent financial advisor side, on the retail investor side, I think there is a huge scope to bring that data-led first approach to improve both sides of those pillars. But it is, to your earlier point about building the cataloging systems inside your business first, so you understand where all the data is and how you can apply it to those two pillars. And if you look at some of the biggest companies in the world right now, have made their data strategy central to their business strategies, and we've seen their value grow as they've provided exponential value in whatever markets they've proceeded to attack. It reminded me of what I saw from a retailer the other day, providing me specials based on exactly what I've been shopping during the last 6 months. And it was quite scary because this is the first time I've actually seen something that's targeted properly, not like selling me a Kaiser Chiefs funeral plan when I'm a Pirates supporter. I mean, they actually understood me. And so we're getting so much better at this in many different industries. Now, when you zoom out of this and you're busy building this business, you've done the deal with core shares, but we've got South Africa's macroeconomic headwinds, and there's so much noise out there, and everyone seems to be quite gloomy. The situation very dire with load shedding. Are there any green shoots of hope? I mean, how do you look at this? Are there any kind of macro trends that you think might force change in the investment management industry?
Michael, you've sort of hit the nail on the head of the gloom and doom. I mean, you've got rising inflation. The markets is taking a proper whack this month. You've got load shedding at level 6. Which is going to impact our economy even more in terms of our growth rate. Even more, the inflation that we're seeing is a push inflation, not a pull inflation. So this is just costs rising, and the consumer will have to keep up to make sort of ends meet, which makes it very, very difficult. We haven't seen this, I think, since the sort of the 1930s depression. Really, this type of sort of inflation push pressure that we're experiencing at the moment. So it's really tough. But you know what? It's tough globally as well. Even in the US, the UK, Europe, everybody's feeling this. And you know what? South Africans are really, really resilient. So my positivity lies always darkest before the dawn. And you know what? It goes dark in South Africa first in in the literal sense of the word as well, So we're in that dark phase. And when it's dark, that's when the clever investors, the clever guys sit up and say, okay, where's the opportunity? So I believe, our market is sort of from a market investing point of view, from investment opportunity point of view, we're actually ahead of the global market. We've taken a lot of the whack out of this. A lot of the sort of the downside is already priced in for South Africa. So I believe there's opportunity is coming for us to come back into the market find investment opportunities, and look look positively through the cycle. Also, I think when it's so dark, we are forced to take action. So typically, people don't take action. Load shedding is part and parcel. When you're on stage 2, it's every half an hour, you don't really feel it. But when you're at level 6, you are forced to take action. So we're going to see action coming through, and otherwise we're going to have riots in the street. But I think we'll have forced action first, which is obviously going to help the whole system to move forward quite quickly.
It reminds me of what Bobby Godsell loved saying. South Africans as a pastime. Well, I think he was CEO of Anglo Gold. He loved telling the story about us loving walking up to the edge, looking over the precipice, and then pulling ourselves back from the brink. We're good on the sports field at doing that. The Springboks did it recently as well. So, it is it's baked into our DNA to go all the way up to the edge to push it there. But then generally things do come right. Do you think that these things are going to start disrupting the industry at the moment? Some of the macro trends that we've just discussed, maybe load shedding, forcing the industry to think differently about the way it approaches things. Well, what do you see as the most disruptive things washing over the asset management industry? Let's phrase it that way.
Definitely. We've been very fortunate over the last if you look at our 5-year returns now for our balance fund, it's been 11%. That's way ahead of inflation. Inflation being 4-5% over that patch. So you got a 6% above inflation return, fantastic returns. And I think that's consistent. If you look at our peer group, it's been in the 9-10% returns over the last 5 years. I don't think that is sustainable over the next while, which means returns are going to get pressed down. The moment you get returns going down, there's a big pressure on fees, because now people start feeling the fees. So if you're charging 2 or 3% fees on a 20% return, it's much less relevant than a 2 or 3% fee on a 5% or a 3% return. And so this pressure on fees is going to continue. And that's why disruption in the industry and what we are doing, trying to provide a high quality product, but at a very low cost for investors, is going to come up. And we're going to see this continuing pressure of fees, and it's going to be the manager that either, in the active side, will be able to provide continuous active returns through the cycle, and that's a difficult job, but those managers, that's the ones that will survive. It's the low cost providers that provides a quality product that's transparent in their fees, where the end investor in the net return, they can see the benefit of that product. And then I think the third component in this is in your private market space, where you're going to see much more activity. When you get these forms of disruption, one typically find a lot of opportunities in the private market space. So that could be private credit, private equity, not just in South Africa, but I think globally. So I see those 3 big trends going forward over the next while as we see this downward compression of returns.
I was chatting to Pete Bauer, the South African-born CEO of Mimecast the other day, and they were taken private in a $5.8 billion transaction in the US, but the timing was just perfect, because the deal was concluded in December, and it was finally went through the last conditionals around May this year. So while all his mates who are CEOs of big listed companies have seen their share price tank 40, 50, 60%, he hasn't seen any value destruction. He's sitting there now saying, well, we can execute on our strategy. We're seeing opportunities in all of the chaos. So very interesting that. Considering where we are in the cycle, and obviously the pandemic, we now finally are mask-free in South Africa. The world's largely recovered from COVID. How do people emerge from this? Have people changed? What do you see as the biggest change? And what do you think the expectations are of the future if we look back over the last couple of years?
So, on your question, I think let's call it two groups of stakeholders that we want to talk about. One is about staff. So, we're a people business, not just from our clients' point of view, but also from the staff. The people that we have in this business. So the way that staff engage within an organization, and I think there's been a big shift that's happened there. So it's much less, in my view, about the monetary value of your employment. It's much more about the benefits, the flexibility, work-life balance. Those things have become very, very, very powerful over the last 2 years, because people have, for the first time in their lives, realized what's the benefits of working from home in an environment that's conducive, but also spending that quality time with the family and not having to spend it on the road, traveling in and out to work. So I think that's a big shift, and certainly we were quite fortunate. We've just moved into new offices here in Cape Town, and we've created an environment where we want to make it attractive for people to come to work, but also not force them to come to work. So it's really their call. And what I found is, we typically have all the staff in the office during the week, but it might be 2 or 3 days that they oscillate between the various working from home or working from the office. But we still create that team culture and that business culture, which is great. So I think that's the first thing. From a client point of view, as another stakeholder, definitely there's been a much more focus on their investment portfolio, their wealth, their sort of ancillary things that they were busy with that they couldn't place all the focus on when they were spending, sort of 8-10 hours at work and 2 hours in the traffic or whatever you had in traffic. Now all of a sudden there was some free time during COVID, and so people could sit back and reassess, what's my future going to be like, and what's my wealth looking like going forward, and what's sort of that tension between having quality of life, spending time with the family, and also making sure that I've got enough money down the track if I want to enjoy these things. So we're seeing a much more engagement from our clients in terms of their wealth, a better understanding in terms of fees, a better understanding in terms of my investment portfolio. So we're seeing a lot of that happening. And obviously with this big push to online, instead of call centers and people phoning you, we've seen that big push as well. So we're very fortunate, 80%, 90% of our direct business is coming through our website at the moment. So it's creating that level of engagement with clients that want to engage with you on an online basis, and they're comfortable to do that, but also then have the ability to have the call centers there if they need to speak to somebody on the other side.
I think there's a golden thread running through all of that, and that's flexibility. I probably would have argued along the lines that would see much more work from home stickiness after COVID if it wasn't for Eskom. I think Eskom, if you don't have a generator at home, it's driving a lot of people back into the office, into the arms of central heating, generally where there is a generator backup and all of those things. I want to come back to what you said about the industry and digital technology. Now, we're talking about an industry that generally attracts very bright, ambitious CFA, CA types, actuaries, and really what you're talking about is big tech skills. So in terms of the industry having talent to take advantage of these opportunities arriving from the technological changes, do you think there is enough talent out there?
Michael, the interesting thing is, if you talk about the industry, let's look at that. I see it as the asset management industry. We've not been built really historically in terms of education from high school through to university in terms of creating the flexibility to bring tech into the financial services industry. It's been quite separate. So where we're finding the talent pool at the moment, if I look at sort of building our tech development team, finding a CTO, it's not sitting in the asset management industry. I've got to go and look at people with Microsoft, Google, Amazon experience. That's where we're looking. That's where we're searching for talent at the moment. Are they there in South Africa? Certainly. There's a fantastic talent pool there. The benefit, and on top of that, is that you can actually now, for a lot of these techies, they can live in South Africa and they can work offshore. So they don't have to be in the office, and that's what COVID has created. It's created a very, very flexible working environment. So, for instance, there's a lot of South African FinTech businesses that's got Eastern European tech development teams, fantastic resources sitting in Israel. Now, similarly, what we've seen now is people moving, sort of good tech people moving back to South Africa, great quality of life, low cost, nice weather, all of that sort of things, back with your family, and they're doing work offshore. So now what we're looking at is how do we bring some of that talent back home in the proper sense of the word. You can certainly find that talent. It's a tough gig because you're competing against somebody that's being paid in dollars or in hard currency, but the pool is definitely still there. And the nice thing is you get that global perspective that these people bring in, even though they're based in South Africa. Or for the matter, you get somebody sitting in Eastern Europe, they've got a big team there, they bring you that global perspective. So that's the important bit that we would like to bring in is it could be homegrown, but offshore developed, and then bring the global perspective back into our business.
And I think those non-financial incentives that South Africa offers, as you mentioned, being back home, close to your family, great weather, best mountain biking country in the world, best wine in the world, all of those things. I mean, those you can't discount how important those are. But when you talk about if you look at the industry and you look at kind of the old guard, the old dogs, as Stephen Kosset likes to call them in Investec, and then the new pups, the entrepreneurs and startups. How do you see that relationship? What is there harmony between the old guard and the entrepreneurs and the fintech startups out there?
It's a tricky one. I think the old guard is, from my perspective, where I sit, I think the old guard is not so much worried about the fintech entrepreneurs or the smaller businesses rising at the moment in South Africa. I think globally, if you look at let's look at the banking side, and I know Michael is going to speak around it as well. If you look at globally on the banking side, you see a lot of these executives sitting there. They've got probably 5-6 years left in their career at that specific bank. They know this thing is coming, and it's like a train steering down sort of a whole year, and they know they're going to be out before they get hit by the rising banks or the digital banks. And I think we have a similar type of mindset in the asset management industry, specifically in South Africa. The big dogs have always won. So, what? It's all about trust. It's about brand. It's all about those sort of things. And therefore, they will maintain their sort of their presence and relevance. Now, I don't think it will go to the other side in a big way in terms of the big dogs don't maintain their relevance and their presence. I just think that it's businesses and firms like us that start speaking to the end customer, whether it's an advisor or in a direct client, in a very different way, where we can engage with them on a level that they don't find that engagement in a different way, in a way that they have in the past. We will certainly get the benefit of that. And that will come, and probably will come quicker because of what we've had and what we've experienced over the last 3 years. If we didn't have the last three years, I think it would have taken much longer. But I think that's one of the benefits that, as a small firm and a growing firm, we have from that pandemic, and we're certainly taking advantage of that and trying to take more advantage of that going forward. And we've seen the benefits of that already.
Yeah, agility. I mean, one can't discount the huge advantage that actually confers on you in such a rapidly changing and fast-moving environment. The ability to adapt and build from first principles again, almost. Just as a last question, I mean, you came back very positive about what you could achieve, and clearly from an entrepreneurial perspective, you see opportunity in hard times. But how do you reconcile the growth story in South Africa, which remains tepid? We pretty much forecast to grow at around our population growth again this year, with your ambitions, with 10X's ambitions for this new expanded growth path?
So there's two ways to look at this. Let's take it, the existing asset management industry at the moment, the existing growth rates in the asset management industry, which in my view is sort of it's X growth. If you look at the in and the outflows over the period, it's an X growth industry. So why would an index business like us succeed in an X growth asset management business? Two reasons. One is passive or index investing is totally under allocated. So in the mutual fund space, we're sitting at 6-7%. In the institutional space, we're probably sitting at 2-3%. That number must be north of 15%. So there's a reallocation that's going to happen where index investing in a 3 trillion rand industry is going to take the benefit. So that's the first thing. The second one within the existing industry is 10X has got a very low market share. And that's just because we haven't played in certain of these markets. We haven't been in the intermediary space. We haven't been in the institutional space. So we have a very, very low market share. And by entering into that market and by providing an offer and a client service solution, we certainly believe we can up our market share significantly from where we are at the moment. So those are the two big sort of waves that we think is behind us. And then in terms of the X growth in the industry, if you look at where the industry has come from, typically it's been advisory, institutional market, very little direct-to-consumer business. So with what we're building in the direct-to-consumer business, we think there's an extra pot here that we will allocate or get an allocation from as the man in the street start investing more and more and more in building wealth in a very cost-effective, seamless way.
And there is a huge appetite. I'm reminded of how many broker dealing accounts there are on the JSE, and it's just under 500,000. I was chatting to Paul Miller of Amaranth CX about this, versus how many registered Luna subscribers there are wanting to trade cryptocurrencies. Now, I don't want to get into the merits of trading cryptocurrencies, but it's in the order of 2 to 2.5 million. So there are many retail investors, men and women, Joe and Josephine blog on the street, who want to get out there, who want to learn more, who want to take control of their investing journeys. And I've often thought that, from the financial media's perspective, that there is a huge untapped potential in that third pot as well to go along with those other two pots. So very bold, ambitious, but certainly well thought out strategy. Tobie van Heerden, Chief Executive of 10x Investments. Great as always hosting you at this year's Business Tech FinTech Conference. Take care.